the data tells us that where it matters, the economy is in recession. And that's the reality. So I still am not coming off the fact that I believe we are in a silent recession, a somewhat rolling recession, a real estate recession, a manufacturing recession. They are there. 70% of Americans are living check to check, and that's getting worse. And so we are in a silent recession for most of the country. And so whether or not it's declared remains to be seen.
Alrighty, folks, we are catching up with the one and only Anna Kelly, longtime recurring guest on the channel, someone I know, love, and respect. Anna, how you doing?
I'm doing great. Great to be back with you.
Absolutely. I had some family stuff last week, so we couldn't make it happen. But I have been saving a list of questions for you, and they're going to come in hot. You ready for this?
I'm ready.
How concerned are you about World War III starting?
A little more today than I was 2 days ago. For those that, haven't seen the headlines, we authorized Ukraine to use U.S. long-range missiles, which they deployed into Russia, I believe, yesterday.
Yep.
And Putin yesterday or early this morning revised downward the necessary threshold to use nuclear weapons. So, just from the fact that is happening and hasn't happened in, our adult lifetime, it's definitely precarious. And so, yes, I would be lying if I didn't say that I have some concern that between, China's threat to go after Taiwan, China backing Russia, North Korean troops now entering Ukraine on behalf of Russia, war gaming off the coast of Alaska between China and Russia and their Navy, Iran and Israel not done going after each other. There's just a lot more conflict and potential for escalation than there has been. And so, as an American, as a mother of fighting age sons, I have concern that things could escalate. Now, without getting political, the fact is we do have a new president coming in. I think that there's probably higher risk of escalation happening before January's inauguration because Trump seems to be tougher than Biden was, at least on the war and negotiation front. But Congress is pretty bipartisan from some things I'm watching in its determination to help Ukraine end this thing, as well as its determination to help de-escalate Israel and Iran. So I'm hopeful that cooler heads will prevail, Michael, that we will not be entering to World War III. But I definitely have concerns that the escalation doesn't seem to be de-escalating. It seems to be going the other way. So yeah, I'm concerned.
Yeah, I mean, World War III changes everything. I mean, it has, and like you say, this is not a question I was ready to ask you last week, right? I had this list of questions ready to go last week, and I had to add this one because post-election, the current administration has basically changed the rules. And frankly, you're the leader of Russia and you've got some U.S. weapons coming into your territory. What are you supposed to do, right? Lowering the threat. I mean, it's such a horrific thought to think about, but
it is.
World War III changes everything. It's not something we like. Frankly, since Putin said that, I think it was early this morning, our time, my hope is all world leaders are like, okay, guys, this is freaking batshit crazy. We got to calm this thing down. Let's get to the negotiation table and make this stop. So maybe that's the comment that shakes the negotiations and peace comes from it. That's my hope. Let's put good karma into the world. We can't have these freaking neocons dragging us post-election into a war that nobody wants. Nobody wants this.
Right. Absolutely.
And to see that post-election that there were some rule changes in the last 60 some odd days is horrific. But again, let's hope that world leaders in Europe, world leaders in Asia, South America, Africa, everywhere are calling up these guys going, okay, guys, let's take nuclear weapons off the table and let's bring peace. So that
absolutely.
I think 99% of the world wants that. So let's hope we
Absolutely.
go
And
that
and I
direction.
believe it was Sweden that I saw. I just looked at the morning news this morning, and I go on to several different websites to get the different realities of different worlds, depending on what news site you're listening to or watching. But I believe it was Sweden that just came out and told their people, stock up diapers, stock up medicines. Like, they're worried. And so I didn't get to go into depth into that article, but the fact that you now have leaders of Sweden worried that Putin might want to continue to escalate this as he's getting, his allies together and upping things. I think it's precarious, and so we definitely need those cooler heads. I'm not making any shifts in what I'm doing, Michael.
No.
Worrying about war. I mean, we've seen that. I think we've passed the 1,000-day mark since Russia went into Ukraine. This is going into 3 years long. It's been over a year with Israel, and things have remained, I hate to say it, relatively low escalation compared to where they could have gone. So I'm hopeful and prayerful that we will not enter a new period of escalating war for sure.
Well, let's just close on this topic and hope when the new administration goes in, again, deal maker at heart, that one of the first things he tackles is frankly peace in negotiations. And, let's all hope that both of these escalations are done by, I don't know, pick a date, February 15th. And we can all just, take it off the boil a little bit and maybe have another 4 years without, World War threats.
Absolutely.
Okay. Now let's go to the list I had prepared until the last 48 hours. This, again, World War III was not on the list when I put this together last week. How about a second round of inflation? Obviously, you're a student of history. You know that in the early 80s, we had kind of that double peak, double top of inflation. It went up, came down, went right back up, really caused the pain of 1982. 2 recessions kind of back to back. It was an ugly and nasty period in the U.S. economy. How concerned are you about inflation 2.0? And again, there's a lot of reasons to think it could come back, right? Tariffs are a threat. Deportation on labor is a threat. Looser tax code, meaning more money sloshing in the system. There are real, concerns, at least at the high level, that inflation 2.0 might be coming. So how concerned are you?
Yeah, absolutely. I mean, I've been saying for a couple of years, and it's just getting stronger. My base case is stagflation over the next several years. I could be wrong. There's a lot of things, just like, our first topic, that could happen that could change things and make the inflation risk even higher. So, you've got 2 different schools of thought, and frankly, I don't believe anyone knows for sure, right? When you listen to different economists. I mean, we have a lot of things that are very inflationary, such as tariffs, taxes, potentially. Some economists would argue that that's not the case. But we do have this global reshoring. And as we do have increased polarity and realignments of allies, which is happening, whether you end up with a World War III kind of thing or not, you do have deglobalization being necessary for national security purposes, as well as for economic purposes. And all of that deglobalization, which you and I've talked about quite a bit on this show, has a cost associated with it. So whether you're bringing back,
Hi, puppy.
Hi, sorry about that. Whether you're bringing back, components to produce pharmaceuticals, 80% or close of our pharmaceutical components are manufactured in China. So bringing back the components so that we can produce drugs here, which is, very costly initially, could drive down drug prices over the long term, which is something that the U.S. wants to do on a bipartisan level. All of the other things that we would want to reshore, bring back some industrial production in order to make GDP go up and the economy thrive, initially are very, very costly. And initially, those things cause the government to have to spend a lot of money. And when governments spend money, Michael, what happens? Despite the modern monetary theorists, we have proven that inflation results ultimately.
Yep.
And so those kind of things make me concerned that we will continue to have pressures that are inflationary. On the opposite side, though, you have the fact that we do, and we have had a 40-year decline in demographics. We are simply not producing as many people who can work, who can produce GDP sufficient to surpass inflation. So when you have less people working and spending, that's actually deflationary. However, the fewer people work, that could cause wages to go up because there's less, people for all of the open jobs, and that could, spark wage inflation. So the point is, there's a lot of these things we could talk about, and they're kind of different pools of a different side of the inflation lever, which could keep it kind of more of a stagflation than a mass inflation. If we do have more inflation than stagflation, I think it's probably over the next several years that we really, feel the brunt of it. And then it starts to stabilize, or you at least hope that you've got enough GDP to counter it to where things are, you're not going backwards and your cost of living isn't continuing to go up, substantially more than wages. So stagflation, yes. Inflation, yes, in the short term. Longer term, it's going to depend on whether the U.S. is successful in getting our debt down as to where Treasury rates go, and all of those things could impact spending and investment, and ultimately inflation as well.
Yeah, so let me put a number on this, because again, it's funny you brought it up. Stagflation is the very next question. So let's stay with inflation for one more second. Again, in CPI inflation headline peaked out at 9.1. I think it last reported at 2.6. So let me put a number on it of 4%. How concerned are you that CPI headline hits 4% in 2025?
Not very concerned. Not very concerned. I think I will say this: the Congressional Budget Office, as well as Fed dot plots and basically predictions, have been that through 2025 inflation would be in the 2 to 3% range. They're hoping to get it closer to 2, but 2 to 3% has historically not been horrible, as long as you had GDP that keeps up with that. So, my bigger concern, I think, is that we stay above 2.5 and 3, and our GDP can't keep pace with that because GDP is inflated already, just like, CPI doesn't fully reflect, how high inflation is. So I don't think we go up to 4 unless we have something like escalation of war. Those kind of things are extremely inflationary.
For sure.
And so that would, if we have escalation of these conflicts, 4% would be hit pretty easily.
Got it. Well, stagflation is the next topic. I know it's something you've been on for probably 18 months as a real concern. How concerned are you that 2025 will go down as a year of stagflation?
It's really hard to say. As we've talked about, it's hard to time these things, and that's what we have learned, and everybody has learned to have to be extremely patient. Is you watch the signs; they're very clear. The signs say we are in more recessionary conditions right now than stagflationary. Yet the government has continued to spend higher, and that puts money into the system, which is keeping GDP higher and keeping us from being in a recession. I think we have more likelihood. I'm not going to go off of my call that we are in recessionary conditions. I have more confidence that we will have a recession finally declare in 2025 than not. And that recession is not the same as stagflation. Correct. I think that the inflationary pressures are here, and that it's more likely that we see a recession first, followed by a few years of stagflationary type conditions.
Okay. I like that. Recession is on the list, but we'll get to that one in a minute. One of the things that I've been putting out there, and again, I'd love your insight on this, is I see 2025 as a year of the Fed really getting behind higher for longer. All right. What does that mean? I suspect there's a non-zero chance that the Fed won't cut anymore. I think there's a non-zero chance that they will not cut in 2025 at all. I think there's even a non-zero chance that the next Fed move is up, not down, right? Again, these are non-zero. These are not my base case. But what this all means is I think 2025, we got to get used to higher rates. And as a real estate channel that starts with mortgages, I think there's more than a 20, 30% chance that mortgage rates will average 7%. Obviously, that will have ripples through the commercial real estate market and the like. So how concerned are you that mortgage rates might average 7% in 2025?
I think our reasons for getting there might be a little bit different, but I do think that the Fed is still going to have pressure to cut at this point because of the fact, again, this isn't headline, but because of the fact that private job destruction is still happening.
Yep.
The jobs and the low unemployment level are really primarily related to healthcare, and they are primarily related to government jobs. And so the private sector job destruction is going to continue, and that is something that the Fed is very concerned about. So I think that even though you're seeing a small uptick in inflation, which makes people say, hey, the Fed can't cut rates, you're also still seeing a deterioration of the labor markets. And so I think that that's going to cause the Fed to want to slow the pace of cuts compared to where they were before we saw this uptick in inflation. But we're still seeing job layoffs, Michael, and we're still seeing a reduction in total hours worked. And those things, again, are usually kind of the precursor to a rapidly deteriorating job market. So I'm not coming off of that because the data doesn't support doing so. So I think you have to look at both sides of the dual mandate. But to the point, I think they're going to cut rates less aggressively than what we had all thought and hoped, unless you see a rapid deterioration of the job market. Then they'll continue to go a little more rapidly. You've also got a new administration, and Trump has been very anti-Powell to some extent. He has said we want interest rates back low. And so, there's going to be a lot more pressure for the Fed to cut rates, even in the face of inflation maybe coming back a little bit. But again, I think the important thing for real estate investors is, regardless of what the Fed does, the bond vigilantes are back, and the bond market has much more impact on real estate investing in terms of long-term rates. So if you're investing in single family homes up to a fourplex, you're really looking at the 10-year treasury rate impacting your 30-year fixed rate mortgages. And so in that 7 range, if the bond market does not adjust, and right now they're worried about tariffs, they're worried about tax cuts, they're worried about all of that's impact on growing the federal deficit. And if the federal deficit grows, there's more risk to holding long-term bonds. If war escalates, there's more risk to holding long-term bonds. And so that is what's going to drive, more so than the Fed, long-term rates being higher. If Trump is successful, this is to play devil's advocate here, in Vivek Ramaswamy and Elon Musk and this Doge department cutting significant waste and cutting our debt and showing that he is going to be able to cut the deficit down even while some of these other things are more inflationary, you might see the bond market start relax a little bit and rates come down a bit. But I think, to your point, we have to be prepared, at least for residential 30-year fixed mortgage rates, to stay higher over the next year or so, unless this recession comes to fruition and we don't have a major increase in inflation.
Yeah. Again, I think, my view is 2025 is going to be much like 1982. Again, 1978 to 1982 is kind of a period that I'm honing in on as a real estate guy. 1982, if you guys don't recall, was the last hard year of that cycle. It got better from there. So I'm optimistic about 26 and 27 and 28 and the future. I just know the business cycle is undefeated, and it just feels like 2025 is the year we got to have some pain, and so there's that thought. All right,
yeah.
How about your fear of a stock market crash? And we'll call a crash 25% or greater. Obviously, we are at or near all-time highs in many of the indices. I do not claim to be, nor do I have any significant dollars in the stock market. So I'm not talking my book, but there's a lot of people that think that earnings will come in because of tariffs, right? Walmart, for example, talked about tariffs on their earning call this morning. There are thoughts that the PE multiples will have to come in. We've talked about the threat of a recession seemingly for 6 or 7 quarters now. What do you think? What do you think the chances are we have a 25% drop? And again, lastly, 2 of my stock folks, a guy named Dan Byrne on Sunday and the Fed guy was just on talking about, stocks having a rough year, much like 2022. What do you think?
Absolutely. First, I will say I'm mostly out of the market, and for a reason. I've missed some of this rally. The market is so disconnected from fundamentals. The PE ratios are off the charts. I believe that I heard David Rosenberg say the risk premium in stocks right now is only 0.25%. Like it should be at least 4 to 5% risk premium. When you've got, treasuries that are giving you in the 3 to 5% range or money market accounts. And so the PE ratios, the market cap of the stock market to GDP are at record highs.
Yeah,
and
that's the Buffett rule. Yeah, it's crazy right now.
Absolutely. And even before the rally after the election, they were only as high in 3 previous time periods before the Great Depression in the 1920s, 2001 and 2008. And so the valuations are based on hopium, on FOMO, on hope that the rally continues, not on fundamentals. With that said, we've seen that has been the case for a while, and the markets continue to go up. So there is a lot of money pumped into the system, as we continue to say, that has a lot of dry powder on the sidelines, and people are making foolish decisions, in my opinion, although they've been rewarded for it. So the question is, how long can it last? If we put our historian hat on, we can see that generally the year after election, there's big market corrections. Generally, after big rallies in inflation, you have recession and there's big corrections. And generally, they've been in the range of 30 to 40% corrections. So do I believe that the market is completely fragile and that it's just going to take 1 or 2 shoes to drop or something unexpected to spark a decline? Yes, I do. I'm not afraid of it because I'm not playing and participating in speculation, which is what the markets highly are right now. The question is, Michael, we've looked at all these stats in history because history rhymes, and all of the indicators that have been perfect indicators of where we're heading are not working right now because of all the artificial money in the system. So it's very difficult. We can say this is what's likely, but how long could this thing go? It could go longer. How much hope is there in Trump being able to cut the deficit and being able to work bipartisan and being able to stimulate growth and all of those things? As long as that hope is going up, the markets will continue to do well until something happens. I'm still nervous about the banking system and commercial real estate and its impact on credit availability if rates do not come down. And those things will impact the markets, as well as those companies who kicked the can down to 2025 with their short-term debt, hoping that rates would be lower, and they're still going to have to come and refi some of this debt. So I do believe we will see a correction probably in 2025, if I had to guess. Could it keep going? It could. I think that it's really wise, if you want to look at history, to remember pigs get fat and hogs get slaughtered. Tesla, Apple, they went up like crazy the last couple of days. If you've got some of that, why? Because Elon was appointed, in the Trump administration, not because of anything that Tesla's doing in terms of its earnings. So if you're in some of these stocks and you're seeing big gains, capture your gains, sell, start taking some chips off the table. And then when markets correct, as they always do, then go back in. So, I'm not nervous, but when they do correct, and I believe that they will probably this year, if history repeats, then I'll be going in when everybody else is coming out.
Yeah. It's funny you brought up commercial banks because that is the next thing. What is your fear of a commercial banking crisis? And again, we'll try to put some numbers on this. I think we've had 4 bank failures this year. a couple because of real estate, one apparently because of fraud. Let's say, I don't know, 25 banks being taken over by the FDIC and, being forced to merge with others. I would call that a banking crisis. That's more than 2 a month, certainly above historical averages. So what are your fears about a commercial banking crisis? Because you can't kick the can down the road for much longer. These 1-year additions, there's got to be a moment of reckoning, and maybe 2025 is it. So what do you think?
Absolutely. 2025 into 2026 is just kind of halfway through, because banks have, a lot of these regional banks specifically, who fund most of the commercial real estate, outside of multifamily, which is highly financed by Fannie and Freddie Mac. There are a lot of defaults, and a lot of the lenders have worked out for 1 more year, have given extensions, kind of this extend and pretend, to say we're extending your rate as long as you keep paying. A lot of people have already had to cash in order to get these banks to continue to allow them not to call the note and default. And so vacancies are continuing to rise. They're not coming back, especially if you look at office. Expenses are continuing to rise, like insurance and taxes. And your mortgage rates have not really come down much in terms of your commercial mortgage rates. And so basically, a lot of these banks, just like, we saw these bank failures, they had to push their bonds over to available for sale instead of hold to maturity, which means they basically had to realize their losses on paper. When that happened, the banks became obviously illiquid. Their liabilities were greater than their assets. The last time I checked, Rebel Cole is somebody that I really watch. He's been advisor to the IMF and to many federal and worldwide banking regulators. He had a list of almost 500 regional banks, Michael, whose hold to maturity type assets between bonds and commercial real estate were over the 300% of equity threshold. Over 500 banks. And so one of the things that you're going to start seeing is that regulations of these banks don't allow them to hold assets on the books and not write them out and recognize that these loans are in default for very long. So they've already had to get some kind of look the other way from the regulators to allow some of these refinances to happen, unless the Treasury or the Fed, FDIC, everybody who's over the banking regulators come in and say, we're going to allow you to have zero reserves, and we're going to allow you to ignore the rules and continue to hold these things to maturity and put pressure on them to continue to refi these loans as long as they can. Unless that happens, these banks are at risk. And I think the number, it was over 100 banks that Rebel Cole indicated were at risk of failure within the next 24 months. Yeah. Also, Tom Honig, who was a former FDIC president and sat on the FOMC committee during the Great Recession, he basically said we're at a category 4 out of 5 risk of additional bank failures. And so if rates stay higher, we commercial real estate investors need rates to fall in order for their cap rates to go down, their values to come up, and to refinance at rates that can cash flow. And so if rates do not come down in 2025, as everybody has hoped with the survive to 25 mantra, not only will commercial real estate failures increase, but the banks will start to fail as well. Now, this is the last, major point here, is that there are several regional banks who have merged. It's not been announced that this is a bank failure, because the Fed doesn't want to announce that there are bank failures. They are going to quietly try to negotiate and broker a lot of bank mergers and acquisitions without using the term failure. A large regional bank in my area just went through this, and there was some local news about their challenges and why they had to be bought. But if you remember back to the 80s, savings and loan crisis, it just started in early 80, but it was about an 8 to 9 year process that we had close to 1,000 banks fail. And so we're just at the beginning, Michael, of this happening. And if rates do not fall and we do not have a recession declared that allows a lot of commercial real estate investors to refinance and, for 5 to 10 years at low interest rates, this is something I'm more worried about than I am World War III,
Mm-hmm.
deep recession, or stagflation, because it's a real risk that we're just starting to see play out.
Yeah, this is the one that feels like it's right here, right?
Yeah.
It's really close to coming, and frankly, I'm already frankly planning on picking up some of those pieces, right? I'm watching some buildings that have bad debt structures, and it's like this. You can't extend and pretend forever.
Right.
So again, it's coming. So we got two more topics, and again, I told you this one was coming when you brought it up. Recession. How nervous, scared are you about an official recession being declared in 2025?
I'm not nervous or scared because I've been expecting it. It just hasn't hit yet, right?
You and me both.
You know, again, the data tells us that where it matters, the economy is in recession. And that's the reality. So I still am not coming off the fact that I believe we are in a silent recession, a somewhat rolling recession, a real estate recession, a manufacturing recession. They are there. 70% of Americans are living check to check, and that's getting worse. And so we are in a silent recession for most of the country. And so whether or not it's declared remains to be seen. I believe that the employment, the unemployment number, the jobs in the private sector, they're continuing to deteriorate slowly. They're not rebounding. And so that tells us that unless, Michael, we have something really stimulative happen in the next year to really bring back private sector jobs, very stimulative, very, very quickly, the cycle and the path that we're heading toward is still recessionary. Will it be deep? I don't think so. There's enough rallying and enough money on the sidelines and enough increase in equity markets right now that people feel like there's more hope and they're still spending. And so that spending, along with government spending, could keep GDP just above, just positive, which will keep the NBER from declaring recession without the 2 quarters of negative GDP. So that's really the open number is, do we technically have 2 quarters of GDP? We did before, and they didn't declare recession. Now we've got recessionary conditions, but positive GDP, completely stoked by government spending, not in the private sector, and it hasn't been declared. So will one be declared? Who knows? Will we have recessionary-like conditions? Yes, we're already there, and I think it's going to get worse in 2025.
Yeah. Well, it doesn't sound like the next one's going to be a very big concern for you, but I will ask it anyway. So we talked recession. Do you have any concern that the Great Depression 2.0 will be initiated and we're going to go through some deep and dark days starting in 2025?
No, I don't. And the main reason, Michael, is because since the Great Depression, Treasury, the Fed, the Congress, and the presidency have all proven that they will do whatever it takes to get us out of it. What that means is more spending, more fiscal spending on a bipartisan basis to keep the country from collapsing. They will do what it takes to keep us from being there for very long. And it means print, give everybody money to keep it from getting to the depressionary status, give everybody money to keep it from getting even too recessionary, and they will kick the can down the road and repeat what they've done, and then that will lead to inflation. So if free markets were to be a real thing again, and let's just play, pretend here, fantasy world, that somehow Trump got Congress and everybody to abolish the Fed, and we went back to true free markets and the government didn't intervene with fiscal policy either, then yes, I think we could head into depressionary type conditions if you look at what's happening around the globe. But I don't think the government will allow us to have a repeat of that. They will pull out all the stops in every agency needed to keep the economy humming as best as they can.
I just came up with one more topic. We're going to throw it in here because I'm curious what you're thinking. Obviously, AI, artificial intelligence, is all over the news. NVIDIA actually reports earnings tomorrow. They're expecting to sell something like $38 billion in AI chips. Crazy numbers. What do you think about AI destroying white collar jobs in 2025?
2025 might be a little too soon, for me, in terms of a major amount of destruction of AI. AI might be blamed, for it. But the reality is we already have, because of just the precarious economic situation and this kind of silent recession we're talking about, people pulling back on spending to some extent, at least pre-election, whether that continues or not. I think that layoffs are going to continue across all sectors. And that will not, tech will not be immune to that, because there is a lot of promise of AI, but there's a lot of different companies that have pegged all of their hopes on AI, all of their hopes for cost cutting, some of the layoffs in AI. And it really hasn't done as much as everybody kind of hoped it would in terms of increased productivity and being able to replace significant number of jobs just yet. I think we've got some time before that really happens. But I think that tech companies that are relying on AI to keep going, even if they're not profitable, you're going to start seeing some of them miss earnings calls. You're going to start seeing some layoff across tech. I just don't think it's going to be because AI has replaced a significant number of jobs just yet. I do think AI has the potential to be a real disruptor and to reduce, some white collar jobs, things like, financial analysts, if you can put numbers into a computer and get it to generate these things, book publishers, all kinds of things that take brain power that can be done more quickly in a computer. I think you're definitely going to have some job destruction there, and it's going to be a disruptor. I think other jobs are going to pop up that don't exist. So, how much of a true net does it have on unemployment in America? I just don't know at this point, but I'm not real concerned. Like, if you ask me, what are the big risks of 2025? I don't think the biggest risk is that AI is going to cause the layoff of a mass amount of people.
Well, let's flip the script. All of these thus far have been somewhere between negative, extremely negative, and really, really, really negative. Well, let's go to the other side. Something that happened in 2024, I had the Fed guy on the channel, Joseph Wang, great guy. He called for, in January, something called a crash up, which I had not heard of up until that point. Basically, the theory is asset prices are going to inflate, which clearly happened. He actually called S&P 6,000. So shout out Joseph Wang. Mm-hmm. What do you think are the chances we just keep going, right? There's $8 trillion on the sidelines, or some crazy number, never been this high. What are the chances, the stock market goes up another 20%, real estate goes up another 10%, crypto, goes up 20%. What are the chances, or any fear of just the crash up continuing?
I don't think it's likely. I think eventually the fundamentals get, negative enough that people have to move from this, hopium to a little bit of realization. The markets, though, you really have to disconnect from Main Street. What happens in real estate is very disconnected from what happens in Wall Street, with the exception that a lot of times people that are investing in real estate are those that, if they've made more money in Wall Street, they're looking for a place to put money to diversify. So they'll go buy more real estate, which pushes real estate asset values up. When it comes to the markets, I cannot see the stock market continuing to go up 20%. I was wrong last year. I'll probably be wrong, again. There's a lot of hope in the change of the administration. There just is. And we see that in Wall Street right now. So who knows? I think we're at all-time highs in numbers that don't make sense. And there has to be a correction back to reality and fundamentals at some point. When it comes to real estate, though, Michael, we've talked a lot about this as well. It really comes down to supply and demand. And supply and demand have a lot of different drivers in different markets. One is jobs. How strong is your local market? And how many people are going to move into those areas for better jobs, even if the economy is somewhat precarious at a national and global basis. So, in areas that continue to produce jobs and don't have as many layoffs and have a higher GDP and a lower cost of living, you're going to have a lot of demand for housing. And we have a limited supply in a lot of those markets, which is going to keep real estate prices high because there's more demand than there is supply. In other markets where people overbought, maybe with short-term rentals, or where people are moving out because of crime and high taxes and those kind of things, as you lose people, you have increased supply and less demand, and prices can come down. And so, real estate is very, very local, and it's very asset class specific. So I don't see broadly single family homes crashing or having a 20% increase, but I do see different markets in single family that could go up or down 20% depending on what happens in the economy. Commercial real estate, I think we've seen close to the bottom. We've had values fall 30 to 40% across commercial real estate. So I don't see mass inflation spiking interest rates so high that cap rates continue to rise and values fall. I do think that more demand comes back for commercial real estate, people looking for a great deal. You start seeing an increase in transactions, and slowly prices start coming back up. So that's my view on real estate versus the stock market.
Very, very cool. This has been a very fun show to talk about. If somebody wanted to learn more about you, they go to AnnaKellyInvesting.com. Is that right?
That's right. If you're looking for passive investments as an accredited investor, or you're looking for real estate coaching and consulting, looking at your portfolio, helping you move forward, analyze deals, et cetera, you can find me and find more about my coaching on AnnaKellyInvesting.com. I'm also at Anna Kelly, REI Mom, on social media.
Anna, you're amazing. Thank you for being here every week. It's been fun. Have a great day.
Thank you. You too.